My guest is Ori Landsman of ING Investment Management. We're focused on our discussion on investing overseas. Ori, what does a falling value of the U.S. dollar do to a lot of these overseas investments? Because, you know, we've talked in the past about how you can have great paper profits, repatriate them, not so great.
Right. So we can understand the translation issues, obviously, if your currency is appreciating, so your stock doesn't have to do as well for the results to look as well. Let's not talk about that. Let's talk about from an economic standpoint what it means. And so, simply put, a weak dollar is very good for U.S. companies that are exporting and very bad for foreign countries that are trying to sell their goods in here. And so people always ask me about Japan, and Japan's actually done pretty well lately. I would say, you know, off a very, very, very oversold low. But Japan is a problem for three reasons. One is that there is, you know, it's the oldest population in the world, so they have just a secular domestic consumption problem. Their main export partners are all either in a recession or coming out of a recession, and their currency has become the flight to quality. It's the most expensive currency in the world, and it just kills their major exporters who are trying to sell into the United States. So it has a big, big factor. My currency outlook has a big impact on my allocation decisions.
So you're not allocating perhaps as much as you would be if the currency was a different story to Japan?
100%. If the yen was at 110 instead of 97, I'd probably have 50% more in Japan than I have.
Interesting. Now talk about what's going on in the energy markets and what that is doing to your thesis, because every time we talk about, you know, the price of oil going above $72, the first thing people say is emerging market demand. It may not be there now, but it's going to be there in the future. You buy that?
Yeah, I do. Short term, I think there's no question that Chinese demand in particular is what's getting it to run right now. But, you know, sort of one of my big stories, and the reason that I'm always here talking about emerging markets, is that not just in China, but in Brazil, in Russia to a slightly lesser extent, maybe in India too, the emergence of a middle class that's actually going to have discretionary income to spend, that has a huge impact potentially on swing demand for all commodities, including oil. And so, you know, I believe that sort of energy is going to get to a normalized level of around 80 and probably at some point trade back, you know, somewhere between 90 and 100, maybe even this year.
All right. Now, if you take a look at what's going on in the oil markets, you can't sort of discount what goes on in geopolitical markets, right? I mean, we've got an election that just took place in Iran, big oil producer, although they do have to import their refined product. What does the election signal to you in terms of energy?
So it's ironic. So first of all, I think that, you know, the election result, at least as we've seen it so far, is shockingly good for the world. So Ahmadinejad looks like he got a third of the vote or less. And so I think there's some skepticism as to whether the mullahs are going to actually allow the election results to go through, and time will tell. I certainly don't have any insight there. At the very least, the people have spoken. And so if you look at history, this is signaling to us that there are going to have to be changes in Iran, which is a wild positive for the world and for investments in general. If the chances of a war in Iran, either instigated by Israel or the United States, was taken off the table, that would be the #1 geopolitical risk pulled out of investing, which is enormous. Ironically,
well, what does that do to oil prices?
Okay, so ironically for oil prices, though, it should have a depressing impact on oil prices, right? Because what drives oil price up, one of the things that drives it up, is the notion that Iranian production may be coming off, that the Straits of Hormuz might be closed. If, in fact, this signals a move towards the West in Iran, it actually means that there's much less of a chance that that's going to happen, and I would actually expect oil prices to fall on that, while the rest of the stock market would probably appreciate.
Do you see, though, demand from a fundamental economic perspective? Do you see this demand for gasoline, for crude oil? Is that something that is sustainable? I mean, $72, I keep talking to people, they say, we got spare capacity.
It's only sustainable if demand picks up accordingly. And so we've seen it short term in China. The question is, can it continue in China? And the only way it can continue in China is if demand picks up in the rest of the world and people start purchasing Chinese goods. So we need to continue to see very good economic data, especially in the United States, for oil to continue to rise, because at this point you need that supply-demand curve to be going up as opposed to down to sustain these prices.
Now, in reference to oil, you did mention what was going on in Brazil. We know Petrobras there, big oil producer, a lot of finds off the east coast of Brazil. What about the rest of Latin America as an investment thesis? Are they going to be able to dodge the big global recession?
I mean, typically they don't, but a lot of those markets, Chile, Peru, Venezuela, are very, very oil-driven. And so if oil prices continue to be high, those countries are going to continue to do well. There aren't many large-cap public ways to play those markets, and they are all clearly larger political risks than Brazil is. But with the exception of Mexico, the rest of those markets are reasonably correlated with Brazil because of their codependence on oil prices.
When you talk about oil prices, would you be putting any new capital to work in, let's say, global integrated oil companies, or do you want to stay specific to different countries, like a Petrobras?
You know, I think I'd rather be in purer plays than the leveraged domestics or the multinationals. They're just, you can get more bang for your buck. I think the real interesting area in energy right now is natural gas. Natural gas is the one commodity that has not responded at all. I mean, it's up a little bit off its floor.
$4 per million BTU right now.
But compared to the other commodities, it hasn't moved at all. The spread between natural gas and crude right now is about as high as it's ever been in history. So I know a lot of people, me included, who are making a bet that the natural gas is going to somehow close that gap. And so that might be an interesting way to play energy right now.
I'm glad we finally found the one real, natural gas bull who's actually putting his money where his mouth is. I want to thank you very much. Ori Landsman coming in from ING, the expert in the world of emerging markets. Thank you very much.